Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. Beautiful summer day. Getting hot out there. I love it.
Yeah, I'm gonna have to turn a fan on here in a few minutes.
We actually have a special guest today, Dave. Coming back for his second podcast appearance is our intern, Cade. Cade, welcome back to the show.
Thanks for having me again. I feel pretty special. 2 weeks in a row,
Yeah,
two episodes. I don't know if there's anything I contributed during my internship. Maybe it'll be a bump in podcast listens.
right. We're gonna pick up your mom too, so that'll be good. That'll be good. We appreciate it, and you're gonna be a pro at podcasting, if nothing else, when this internship is over.
That's the
That's
goal,
right.
right?
Right.
That's right. Well, we're glad to have you. And today we're going to be talking about a little project you did for us this summer. You want to kind of share what that is, Cade, and kind of how you put it together?
Yeah, definitely. So I kind of like to think of it as you guys hired me for my internship this summer and gave me this project to justify your jobs. So
He's
no,
on
so
to
I
us,
kind of did
Dave.
a
He's on to us.
Yeah, yeah.
one of the summer projects for my internship that Nick and Dave gave me was going through and kind of trying to break down, what an advisor does and the tangible, quantifiable return that a client receives from that. So there were quite a few good studies out there. Fidelity had some, Russell Investment Group had one, but the big one was Vanguard had a study called an advisor's value in alpha, advisors alpha. So they kind of broke it down into, asset allocation. So, what you're invested in, how you're invested, and then looking at the cost of those investments and how advisors can maximize that. And then portfolio rebalancing. So, kind of realigning that portfolio to be in line with your investment strategy and your risk and whatnot. Asset location was another one. So, where your assets are at, what type of account, and what type of assets are in each account. And then a
Hmm.
withdrawal strategy from those accounts, and kind of how that was structured. And then behavioral coaching. So then each one of those was broken down and given uh, a return based on what an advisor can do for a client. So
Hmm.
Vanguard's study kind of said that, being cost effective is about 0.3% return to your client. Portfolio rebalancing is about 0.14%. Behavioral coaching was kind of a wide range, was 0 to 2%, kind of based on your client and what you can provide for them. Asset location was, again, same
Right.
thing based on the client's situation, is 0 to 0.6%. And then that withdrawal strategy was 0 to 1.2%. So if you kind of average all those out and throw them together, Vanguard kind of thinks that advisors return around 3%. Over the long run, it's not necessarily 3% a year by hiring an advisor, but that's kind of the tangible services. Now, you guys do a lot more. I've seen that you do a lot more than just these tangible things. So yeah, that was kind of the summer project. I wrote an article on it, so I would imagine that will probably be out on the blog at some point. If the listeners are interested in reading the article, it'll be pushed out somewhere. So that was kind of one of
Yeah,
the
we'll
summer projects, was throwing that all together.
Yeah, we'll link to the article in the podcast notes here, as well as links to the Vanguard study, if not some of the others. Um, so I guess I would absolutely love to be able to tell clients, look, Vanguard's shown we had 3% value year in and year out. My my gut feeling is that we add value in lumpy situations throughout the client's life with us, if you will. Um, out of the things that Vanguard raised, which one struck you as the most valuable?
To me, I think behavioral coaching is the most valuable, because individuals, if they want to spend the time, they can really do cost effective investing and their own rebalancing and asset location. While it gets tricky, if they have the time and the know-how, they can do it. But what you can't provide yourself is behavioral coaching. You really need an outside party. Um, so Vanguard, I really liked one of the things they talked about was, they kind of compared advisors to emotional circuit breakers and how they can kind of help control the emotions, of investors. So I thought that was really cool. I don't know if you guys have any more insight into that, but
Yeah,
I
I think that one for me was the biggest one that I saw on here, the behavioral coaching side. Now, how you can, deduce that down to a 2% additional rate of return, I have no idea. I'm sure they have some good facts and figures behind that. I guess it's a little bit, it depends on client behavior to begin with. But I do feel like that's a huge one for us. And it's not just like, to me, it's not just behavioral coaching and like making sure you stay invested, but like having somebody that you can know and rely and trust
yes,
on, so you don't have to worry about that day-to-day stuff, I think makes a huge difference. Whether you can quantify that as a 2% difference in rate of return, I don't know. But I know from just the standpoint of quality of life, I would say it was way higher than the 2% rating that they gave it, right?
yeah, I would build on that and say that sometimes it's not behavioral coaching per se, like stopping people from making mistakes, but maybe giving them the confidence to do the right thing. And by that, I mean, all this information is out there, right? I mean, none of what we do in financial planning is proprietary. It's not something Nick's trademarked or that I've come up with that no other financial planner has ever thought of. The information's all out there, and I think this falls under behavioral coaching, but a lot of what we're doing is filtering
mm-hmm.
and basically saying that this is the part that applies to you out of all these things that you're hearing out there, and here's why. And it's as much a validation process as it is behavioral coaching.
Yeah.
Yeah, I would agree. Kind of from what I've seen, and through my internships and stuff, is it's really that peace of mind and that confidence that you can provide to clients. And a lot of times, it might not even be about the markets. It might be about something going on in their lives, or they're worried about retirement and how they're going to spend their time, and just kind of somebody to talk to. And you're kind of a financial therapist, is one of the things I like to call it. Um, and that's just invaluable. So, Vanguard kind of came up with that 2%, I think, because they took what the S&P 500 returns and what an individual investor returns, and the individual investor underperforms by around 2%, and they're going, well, if you had an advisor, you'd match that, which isn't necessarily true either. But that's where that comes from. But that peace of mind and the confidence and somebody to talk to that they trust is truly invaluable, I think.
So,
And where I think it really relates to kind of where we're at today with all of this AI kind of overtaking things, you can go to Chat GPT and get a lot of these things, but there's a different interaction when you have to sit in front of another human and there's emotions involved and you have to tell them, hey, I didn't save what we talked about because,
mm-hmm.
for whatever, and justify that, you're more likely to do those things that you need to do. If it's just a chat robot, you're just going to say turn it off or whatever. There's no like emotional connection there to have to do those things that you said you were going to do, because it's just a robot and it's just going to spit out more information, right?
or to
Right.
figure out contingency plans because something's not working. Yeah.
Right.
Yeah. Um, so how much value did Vanguard assign to picking individual stocks?
So that was what was kind of interesting, is they really didn't. They said they made it arbitrary.
Yeah,
It was.
I set you up with that one.
Yeah, you knew that. You read the article. Come on, Dave. You proofread it. No, yeah. So it's just arbitrary, especially in today's day and age. I mean, and with investment strategies, it's just a lot of the new investment strategies are not. It's not the hot stock of the day. It's broad diversify yourself and stay invested in the long run. And if you don't want to do that, you can get stock picks from
Mm-hmm.
robots and AI, and they're Jim Cramer's
Right.
turning out things to buy every day on CNBC. So it really doesn't have doesn't have any value anymore.
Right. Um, I One of my favorite personal finance and investment writers out there, Paul Merriman. Um, he said in an article a while ago that if he could add 0.5% a year net after his fees to his clients' investment returns, he had really done his job. Because if you take that and compound it over time, that makes a big difference in people's lives, just that 0.5% value. And I think it's interesting, Vanguard's come up with a much bigger number, but the truth is it doesn't have to be, that to have an impact. As long as we're, providing value above and beyond what people are paying us, that's the key, right?
Exactly. Well, that was kind of one of the things I did in the article was I took, the 3% that, Vanguard says, the advisors add, and just took an investment that returns 4% and one that returns 7%. And over 35 years, that 3% difference, triples the investment. So even if it's a
Right.
0.5% or 1%, that makes a big difference. And it's kind of interesting. I can't remember who it was, but I was, one of the things I was reading was, and it mentions it in the Vanguard article too, is it's kind of hard to think about that because we think linearly in our daily lives. We don't think exponentially. And so to really grasp that, and then the other thing is, and you mentioned it earlier, is this doesn't come 3% every year. You get 3%, 3%. It really comes in lumps. And so, one year, maybe the behavioral coaching aspect really saves somebody and really returns a lot of value. And then the next year, maybe it's the withdrawal strategy as they enter retirement. And so it's not necessarily that each one of these categories is cut and dry and returns the same value every year to a client by hiring an advisor.
Yeah. There's another aspect that they don't address, which I think is interesting to think about at least. So sometimes we'll have a client come in who is oblivious to the amount of risk they're taking. Okay. And say they're 60 years old, getting ready to retire in a year or two. They've invested their entire career and just put everything in stocks, and it's worked out great, right? But now they're at a point where we actually have to tell them, look, you're going to start withdrawing from this portfolio. So now we need to take some risk off the table. Now, there's a good chance that what we're doing when we advise them to do that is actually hurting their returns, because we've got to account for that risk, right? And there's a good chance it won't ever happen. Kind of like paying for car insurance, right? You're spending several $100s a year for something you hope never happens. But if it happens, you need to make sure you've got the car insurance. We have to prepare a client when they're shifting into distribution mode for a potential market catastrophe, right? We have to take a portion of that money and put it into something safer so that they can withdraw it. But there's a chance that will never happen. And if they had just gone through life oblivious to the risk they were taking, they may have a larger portfolio 25 years from now. So when we talk about cost and benefit, some of those intangibles may actually reduce return, but they are important to keep in mind. That's an important aspect of financial planning, that risk capacity factor.
Yeah, I definitely agree. I think risk versus reward.
Oh, we lost you.
There?
Oh, are we back on?
You lost me.
Everybody froze there for a second.
Faded out for a second. No, I was just going to say I would add to that, Dave, as well. For a lot of people, sometimes it's about teaching them and helping them spend money, which they're not always great at, right? Like the flip side of growing wealth and adding value is being comfortable to spend money that you've saved for a long time. And that doesn't necessarily show up in this study. It goes the other way, right? It's like, hey, you've got all this money and we're doing all these things. Do you want to die with millions of dollars, or do you want to maximize the time you have right now, right? Like those are conversations that we had that don't necessarily quote unquote add value to the portfolio, but certainly add quality of life and a lot of other things
Right.
too.
Right. That's a good point too. So at the end of the day, it's nice to look at an investment firm's analysis that has this nice big number, but it's very subjective. It's going to be different for everybody.
Well, if I'm looking at this from the consumer side, I'm going into these things and if I'm interviewing a financial advisor, I want to know not necessarily what your portfolio is going to look like. I want to know how you're going to help me with the behavioral coaching when things go wrong. Like, what things are you doing to make sure that you know how I feel and how to, keep me on track or whatever that is. And obviously withdrawal order, if I'm going into retirement, I want to have a very long conversation about how you're going to structure my withdrawal order and what your thoughts are on that and how that all plays into it. Not necessarily what you're going to, instead of just getting a portfolio proposal, I want to know about those things, right?
So I'm jumping into our list of future podcast topics right now, and I'm putting on there the questions you should be asking that you're not, because most people do ask about what are you going to invest in? What funds do you use? What have returns been like on that model? And it's not that those are bad questions. It's just that you don't get a complete view of where the value really comes from that way.
Well, yeah, I mean, that stuff is super important, but if you're going to pay for a financial planner, that should be a part of it. Shouldn't be the only thing that you're getting, right? Like, you want to get the behavioral coaching. You want to make sure that that's a fit. You want to make sure the withdrawal order stuff is there, because that's going to add a ton more value than just having an investment portfolio that's allocated and the asset location and all that stuff that we talked about. So, Mr. Cade, what do you think was your main takeaway? As obviously you're starting your career, did this scare you off, or do you feel like you can go out there in the world when you graduate next year and deliver on some of this stuff?
No, definitely. I think it's really cool. I think it's cool that there's this data to kind of back up the tangibles, because you can back that up. But like you guys just said, there's so many intangible things, and sometimes it's hard to explain that to your client, and they go, well, why am I paying you? Well, now you can go, well, look at this study. Here's one thing why you're paying me and justifies the cost, plus, the intangible things and the understanding your clients. And like you guys were saying, you guys do a wonderful job, I think, of really truly understanding who your clients are and what they want to do with their money. And, the data point surveys, all your fit meetings when you get a new client, and truly understanding who your client is, what money means to them, what their goals are in life, and being able to deliver on that and really help them out. So, it's in addition to these, you get this to back you up, right? I'm 22 years old starting a career, and it's like, oh, hey, look, I can return 3%, yeah, that doesn't really matter, but it's there in the background if you have to use it to market yourself. But there's so much more to it. I think you guys did a good job touching on that. And I think that's what's really cool about the job.
Well, I will call this a successful internship then.
I would
That's
too.
Right.
I would too.
That's what I like to hear. Good.
I think that one of the big takeaways from this summer was kind of what my future financial planning kind of creed will be. And I think really understanding clients and what money means to them, and it's not always growing their portfolio to the largest number. It's the peace of mind. It's helping them achieve their dreams and their goals. And that was kind of my big takeaway from the summer.
Excellent.
Awesome.
Excellent. I love it. Good.
Well, we definitely enjoyed having you, and we probably learned just as much from you as you did from us. So you got a week or so left. We're going to squeeze every bit of that out of you. So, but it's been a great pleasure for us.
Yeah, send me some more projects.
Thanks for doing this. Thanks for coming on.
Yeah.
There you go.
Yeah.
All right.
So
thank
if
you
our
guys.
listeners have any questions, Yeah, you bet. If our listeners have any questions about this episode or other episodes that you'd like to hear about, feel free to shoot us an email at info@srbadvisors.com. Cade and Dave, it's been a pleasure.
It's fun as always.